At MyArtBroker, we've spent the past decade translating 4 decades of human expertise in the prints market into code. The result is a valuation algorithm that behaves like a specialist who's been in the print market trading for 40 years, only faster, always awake, and never commercially biased. Alongside the algorithm sits My Portfolio, our collection management tool, and the trading floor, a live marketplace where supply and demand are anchored to the model's fair value. Together, they create a feedback loop. Every transaction redefines the dataset, and every new data point sharpens the next valuation.
You often describe the valuation algorithm MyArtBroker developed as a brain. Is that because it's built on machine learning?
So you can think of machine learning as teaching a child to spot the difference between a Labrador or a poodle. You expose it to thousands of pictures, label them, and the child starts to recognize patterns. It's largely the same. And that's what our algorithm does with prints. It isn't a rule-based robot. It's much closer to something that a financial quant would build for a trading desk. It's meant to be disciplined, pattern recognition-based, that improves with every data point. There's a cycle in place.
So you would place it firmly in the machine learning camp, not general AI?
I would. There are elements of AI embedded in the pattern recognition layer, but the core is supervised machine learning. What we do is we feed it verified results. It measures, scores, and refines itself continuously, literally every time a print changes hands.
Why was it necessary? What is wrong with traditional valuation practice?
What's wrong with traditional? There's nothing actually wrong with traditional valuations, but there is a problem in the market around valuing prints and multiples. There's a huge amount of opaque, difficult, what we call dirty data, and a lot of commercial bias. In the traditional model, you see only part of the picture. There's expert opinion, anecdotal provenance, and mainly top 3 auction houses that play for those data models. Fees are often hidden. Hammer prices include buyer's premium. Retail galleries can embed maybe 50 to 100% margins in the prices that they give out. Take Warhol's Marilyn prints. If you walk the high street, you'll find a high street gallery quoting £500,000. At the same fair, a mid-sized dealer might whisper 350,000, and an online listing might sit at 275,000. None of these prices break out shipping, insurance, 25% buyer's premium, including VAT on top. And for a collector, the spread can top £150,000 on a single edition. I mean, that's not transparency, that's noise.
Has the online market not created more transparency?
You know, in many ways, digital platforms were meant to fix this. Yet the kind of multiplication of noise and information online has become the problem. Anyone can harvest data, but without cleansing, you end up comparing apples to steak knives. A Sunday Bee Morning after Warhol print sits next to an authenticated original, both tagged Marilyn, and the website search has no idea which is which. The result is disparity that scares new entrants and erodes a huge amount of trust in the market.
You've also spoken about auction house incentives skewing estimates.
Yeah, I mean, specialists inside auction houses live and die by sell-through rate. That drives reserves and low estimates down. An unsold lot is a black mark. There's also a performance commission if the hammer lands above the high estimate. So the high estimate tends to be relatively conservative. And then you add something like vendor pressure to that. So, you know, you'll take my Marilyn, but guarantee me X. And you have commercial bias baked into every public figure. So where you used to have a huge amount of auction data that was relatively public and transparent, it's logical to put that pricing strategy in, but it's hardly objective.
And all of that is before we touch condition or provenance.
Exactly. I mean, a Marilyn with unquestionable provenance and mint condition might achieve double the price of one that was rolled in a tube and traded 10 times in 5 years. Yet these are nuances that rarely survive into a public spreadsheet. You know, there's prices are what they should be in many places because of those micro valuation trends.
Given that complexity, how did you translate a specialist judgment into code?
So we began by shadowing the best print specialists we know. People with 40 plus years of gut feel and experience in the market. All our specialists come from the top 4 auction houses because there is no other place better at teaching you and seeing so many prints. And that specialism, that human expertise was absolutely crucial to getting the algorithm to work in the first place. and writing down every variable from what the process they went through, so that they subconsciously are weighing up different factors. That list ran into the hundreds. And the algorithm now evaluates more than 40 of those at scale. But you can group them under about 10 different headings. The first is auction houses. We harvest over 400 auction houses globally, which is quite unique because a lot of the other pricing models don't look as broad as 400 auction houses. With the prints category, you really have to look that broad because there's a huge amount that's sold. Not only, it's estimated that about only 34% of prints and editions go through auction houses to start with, but you'll find that a huge amount of editions sell outside of the top 4 auction houses. So we're removing that, we're including the headline 3, but actually we're expanding that. So we have the most robust data set that is niche to the prints market as possible. The second factor is private sales data. So every single trade executed on MyArtBroker's trading floor in our brokerage team is accounted for within the algorithm. And secondly, a synthetic valuation. So every formal appraisal we issue, even when no sale follows, is harvested and digested by the algorithm. So you already have a much larger data set than the public auction data is allowing for. One of the other factors we look at is unsold data. So how often a work meets the market and is rejected. And that could be for various reasons. We've talked about pricing strategy, and quite often that pricing strategy does come into play. But what it allows us to do is look at the supply and the demand within the market and what estimate it was set at and why perhaps it didn't sell. The other thing it does is look at the relationships between colorways and series, so comparable colorways and series relationships. Bridget Riley's fragment A illuminates fragment D, just as Warhol's African elephant informs his entire endangered species series. We've talked a lot about how condition affects value. Well, condition is a vast spectrum, and allowing every single one of those prints, regardless of the condition of it, to be harvested into the algorithm allows for a better average when it comes to the market. There are multiple Warhol prints. These prints were not produced necessarily as fine artworks. They were often, handed out at the end of parties. They're not meant to be in immaculate condition. But by harvesting enough Warhol data, what we can do is understand what the sense of the market is, how many are in good condition, and how does that affecting its value through our private sales and the public auction. But we do tend to discard works that are perhaps from extraordinary provenance. A work that was owned by a celebrity is almost outside of edition. That provenance value is so high that it shouldn't really come into the algorithm. We have a full-time digital archivist who tracks these data points and ensures that is kept up to date as much as possible. One of the biggest challenges we have is that auction houses don't catalogue things perfectly. And so quite often you'll have something seeping into the original print data that isn't quite what it seemed to be at auction. So there's a manual process going through that all the time. There's the other part of this is provenance and tenure, 30 years in a private collection versus serial flipping, celebrity ownership versus anonymity. There's a macroeconomic context here that we have manual manipulation on all the time, on a daily basis.
How complex does the data go in terms of length and its own learning?
Our look back stretches 3 decades. So recessions, booms, and rate cycles are baked in. The original's market influence, record-breaking canvases ripple down into editions with a very measurable lag. And then there's structured feedback. So the brain scores its last prediction against every new verified sale, updates its error term, and adjusts the weighting in real time. We call this last step repeat regression technology, and in plain language, it's the brain marking its own homework. A human specialist can do that once a quarter, but the machine does it every 3 hours.
You've said the model occasionally works against your specialists. Why keep it that pure?
Yes, the model does sometimes work against our specialists. Look, we categorically reject commercial bias. Our founders, Ian and Josiah, they were collectors before they were brokers. They knew what it felt like to be ripped off by opacity. Our job is to keep this market healthy for the long term, not to ride a bubble. The brain has zero interest in its margin or commercial sense. And sometimes that means telling a vendor their print is worth £35,000 when they want £40,000, or explaining to a buyer that £45,000 is unsustainable. It stings in the short term, but it preserves liquidity and it nourishes the market. I mean, look at what happened to the Banksy market in 2020. The major houses flooded supply to satisfy demand, prices spiked, and the market had to recorrect. We can't afford that. Prints are the backbone of our business. A transparent, data-driven, fair value curve is the best defense against boom and bust.
A number of dealers have reported a live algo sighting is too low. What do you say to that?
It's a real challenge for dealers whose consigners expect above market returns, as it is for us every day, but supply is hard enough without inflated expectations. We actually invite dealers to adopt the algorithm. Imagine pricing a print in real time, armed with a fair market value feed that adjusts the moment a fresh data point enters the system. I mean, that is the real opportunity here. And a dealer who can show a collector on screen exactly where the print sits relative to, every verified sale in the past decade earns immediate credibility. They close sales faster, vendors gain realistic expectations, and the broader market, freed from inflated asks, runs much smoother.
Where does the algorithm go next?
Coverage and connectivity. We are onboarding smaller regional Sauron data every day, stretching back through archival catalogues and ingesting additional private sale channels so the brain never stops learning. The next milestone might be an open API, dealers, insurers, even lenders who will be able to plug directly into the valuation feed with the appropriate throttling and surface live fair value data inside their own platforms. Once that infrastructure is in place, the market gains something that has never truly had, a neutral benchmark. At that point, every participant, from the first collector to the pension fund exploring art-backed lending, can reference a shared, verifiable price curve.
And for collectors?
For collectors, it means more confidence, faster liquidity, and crucially, a far lower barrier to entry. Fair market discipline is not a slogan. It's the operating code that powers MyArtBroker's algorithmic brain. And by compressing 40 years of specialist judgment into an always-on, self-correcting valuation engine, we remove opacity, resist commercial bias, and keep the prints market healthy for the long haul.